Okay, Gio, welcome. It's great to have you here and be in Amsterdam. Tell us about yourself.
Well, I'm Gio, and I'm very happy to be back in Amsterdam. It's been a while since I've been here. Originally born here, living in Dubai. Let me do the boring stuff first. I'm the Chief Strategy Innovation Officer for a bank in the UAE, where I also kind of founded the Innovation Lab and the corporate VC. What it really means is I get to do a lot of what I consider the cool stuff in a bank, but it also means that, you know, within the bank, I'm that guy that creates a lot of trouble. I am really much a hardcore degenerate art collector on chain. And you heard me on the panel, I'm going to say it again, but I am professional exit liquidity and I'm a DeFi maxi because I genuinely believe like you can't really understand systems if you don't participate in those. Right? And I would have, to be fair, this is something I do outside of the bank, but it also serves me in the bank.
I'm interested to explore 2 points. One is the kind of the beginning and one is where you are now. So how did you kind of get into this? And when I say this, you talked about yourself as a sort of DeFi maxi, by kind of on-chain art. Like, what was your entry point?
See, I'd love to say that in 2008, I read the Bitcoin white paper and I got converted into the cypherpunk mode, but that's not really true. But the thing that really got me into the side door is NFTs. And so I've always been a sneakerhead and a collector of collectibles, Japanese toys, Transformers G1. And so a lot of us in that time kind of pivoted on chain when Artifact came out with Clone X, which was heavily sneaker culture inspired and later was acquired by Nike. And so for all of this, there was kind of like a slight side door into NFTs because the notion of collecting provenance art on chain, it just made a lot of sense. And the PFP, right, the profile picture concept of it. And so that's kind of how I got into it. And then at some point, one of my closest friends red-pilled me into Solana and particularly MonkeyDAO because he was a member, OG member. And the first time when I joined MonkeyDAO was the first time I realized like, oh, there's a bunch of people from all over, you know, not just the world, but in terms of, you know, you have bankers, you have artists, you have builders, you have all these kind of diverse people all coming together in this kind of like almost utopian community. And for someone like me, who's always been kind of like struggling with the duality of who I am, not fitting in neither here nor there, it's the first time I really felt like, oh, I belong, right? This is great. Like we're building a new future.
And I really love the language of sort of fitting in, not fitting in. Some might argue that your presence in a more established, even legacy global financial institution, you know, 5-10 years ago might not have felt like you fitting in. When did you feel like you fit in, sort of professionally, I mean, in a kind of big financial institution? And do you think that's kind of just the way these big banks, these big legacy financial institutions are now going?
I love that you think that I fit in. Well, I'll take that. I don't actually think I fit in, but I think there's more of a appetite to have people that don't necessarily fit in be part of the fabric of these kind of organizations. I think it comes down to people understand there's a need to change, and particularly in the UAE, I think a lot of it is driven by the government, right? There's a big, strong mandate from the government pushing the private sector into embracing innovation. I think it's hard to do innovation in a bank. And that's why I'm saying like, I don't necessarily think it fits in because the risk appetite statement that you have when you do innovation is fundamentally opposing to what the bank has, right? And you know, a bank is a regulated, in our case, we're a listed regulated entity. And that comes with a whole bunch of things that you need to adhere to, and rightfully so. Whereas my job is to kind of like, I like to say, my job is to break the eggs. Theirs is to protect the eggs, right? But at the end of the day, the way I look at it is if you want to get that omelet, you got to break some eggs. And so how do you do that? And there's always tension between those two.
Interesting. You have mainly worked in kind of Web3, let's say, in really sort of interesting parts of it as well. At what point did you decide, actually, the way I can advance my professional interests and just the kind of the interests of Web3 more generally inside a financial institution? You just talked about, you know, there's more appetite there, or rather there's more appetite for innovation, but what was the sort of tipping point for that?
I think ultimately it came down to, this is very personal for me, it came down to like, I was tired of struggling with the duality and having to be, you know, one person in one room and one person in another room, and neither one of these persons is actually me. I just kind of felt like I was being representations of me in different rooms that all expect a different language from me, and I just got tired of it. I'm like, I think we're at a conversion point where you can be all of those people in one. I think timing helped because I think 5, maybe 10 years ago, you wouldn't have been able to do it so naturally. But increasingly, as institutions are more eyeing what's happening on the blockchain space, and to be fair, people in the blockchain crypto side are more interested these days in talking to institutions. There's this conversion where you need translators and bridges. And so personally, I got tired of just having to be one or the other because all of it is me. And then there's a conversion of, there's a natural interest at a professional level. I also will say this, I think you need people inside the banks that kind of understand it, who can translate it to kind of get that appetite. Because the appetite is there, but most of the time it's kind of locked behind this asymmetrical understanding or misunderstanding of what the other world is, right? And so you need people who kind of connect the dots.
I want to turn to a little bit what you said around appetite, but the success of a lot of Web3 projects, or in this case, actually a lot of lack of success. You know, lots of figures out there, some as high as 99% of Web3 projects that just sort of amount to nothing or kind of make nothing in terms of profitability. How do you decide what you're going to back? And particularly now you're in or have been in big sort of regulated institutions, how do you help them also decide what to back given their risk appetite?
It's very different from an institutional perspective, from a personal perspective, right? Like, I'm a terrible trader, so right, I buy with my emotions. But at an institutional level, I think, well, look, let's unpack those stats. 99% of these projects is not profitable, right? That's 100% true. I can't argue with that. But at the same time, I also think there's a little bit of a play with stats in the context of what does it actually mean to be profitable. And so if you look at these business models for most projects, it's TGE, right? The issuing a token, and then that token allows both the founders and the early VCs to kind of get to cash out early and get liquidity. And I think that is, to an extent, a little bit of a perverse, misaligned set of incentives for the founding team and the early backers versus, let's say, the market. But the parallel to that is not that different if I think about it in terms of, you know, fintech. You look at Uber, you look at Amazon. Both of them subsidize parts of the market to get user acquisition, right? To increase the friction of switching and to create network effects. And then over time, there was a promise that it would become profitable because both of them lost a ton of money for a very, very long time. And investors knew that, but they were investing in future value, future profit coming in once you create this moat and market share. So I don't think that playbook is wrong per se. And I think in Web3, companies like Uniswap have executed that really well. The problem is when you start subsidizing without a clear path to monetizing, it's different. And so what I see is you have a protocol and they're subsidizing people because effectively you're renting liquidity, right? You're subsidizing people to say, hey, you know, you're going to get significantly more than anywhere else if you park your liquidity with us. And people do that, but the cost of switching is actually very low, which means you get yield farmers, because the moment you can no longer afford to, and you will get to that point, they will just take their liquidity and go. So you haven't really built anything sustainable. You haven't really built users and loyalty, and you haven't increased the cost of switching high enough for these people to stay with you after you stop subsidizing. I think that's a problem. And the second thing I'll say is this. A big part of this is also reframing what does it mean to be profitable. You know, YC came out, I want to say a couple of weeks ago. Super interesting. They came out with this tweet and I guess this manifesto that they wrote in terms of how do you actually calculate ARR? And that was not for Web3 companies. Well, it was for all companies, including Web3 companies, but particularly also for AI companies and fintechs. And so their notion was like, just because you had one good month or one kind of like big shot of revenue, or if you're a protocol, you had one spike in TVL, you can't just X12 it and kind of go like, oh, that's my ARR. Yeah. And so I think that's also a reason why when you talk about profitability, how do you define profitability? What's sustainable profit, committed contracts? You know, that's my take on that.
At the beginning of what you just said, you mentioned, I think, a really interesting analogy around, you know, Uber and Amazon, who have built their markets sort of on a loss leader model. They pump lots of resources and money in, they capture the market, and then they kind of work it out from there. And I'm assuming the main reason they're able to do that is because they've had, let's call them big backers, sort of established, you know, money movers, VCs, financial institutions. Do you think that factor, so the big backers, is now more prevalent in Web3? And do you think that's going to change that 99%, not failure rate, but kind of 99% lack of profitability? Will it go down?
I definitely hope so. It should go down. If I were to look at it as teething problems of a maturing industry, by all means, it should go down. Are there bigger backers involved now? I think A16Z is doing a ton of work in the space. But I also kind of, my sense is they're also changing a little bit the way they're doing it. And so I think that everyone sort of agrees that the old way of doing things is no longer working. So, you need to pivot to a different business model. I still see protocols raising a ton of money at seed level that honestly a fintech or AI company would kill for. So clearly there's capital. I also think there's still enough ambiguity around where the space is going to go that people consider these like, outsized future looking bets. Right? Building the new infrastructure for a new financial system, whatever, or digital identity management, whatever it may be. So I think there will be capital. The problem will be if you don't mature with that, at some point that capital is going to stop coming because, capital flows where capital is most efficient.
Yeah.
And based on the stat that you mentioned, I don't think people would consider that to be a most efficient way of deploying capital.
And given the fact that I'm going to call it a venture, it's more than a venture, but your sort of venture operates within a large, established, slightly risk-averse financial institution.
Not slightly.
Okay, fair enough. Yeah, very risk-averse. Let's imagine that gives a certain sort of safety net for certain projects, right? There's a financial safety net, there's a sort of compliance and regulatory safety net as well. Is that necessary? Is that a necessary condition for better success of some of these projects?
When you say safety net, you mean a safety net for me operating ventures within a bank?
Yeah.
I would say no, I'm not arguing. There is no safety net. I have to earn every dollar I spend twice as hard, probably as a founder would have to. And I have to earn the right to even want to try new things. Because on my side, there's real maturity in assessing viability and looking at financials, assessing it from a compliance perspective, from a risk perspective. And on top of that, we are obviously being regulated. So there's additional scrutiny. So no, I have to fight extra hard. And afterwards, I have to prove that something worked, because if it doesn't, I won't get another dollar to do anything new. So no, I don't think there's a safety net. Quite the opposite, actually.
Interesting. So what's attractive about it to you? Because you're working twice as hard, you're operating, you're a guy that's used to operating with a certain level of risk and uncertainty in an environment which wants risk and certainty. Yeah. Where's the kick?
That's the kick, the tension. The tension is, this is like almost, it feels sometimes like a Mission Impossible. And if you look at Tom Cruise in Mission Impossible, every mission he goes on is impossible, but that's kind of what draws him to it.
Yeah, right.
To trying to make the impossible possible. And that's kind of a cheesy way of doing the Dubai slogan. But in a way, that's really what it is. It's this notion of, if you can do it here, you can do it anywhere. And at the same time, I feel I have a personal mission. I think banks, large financial institutions have to change.
Yeah.
We have to. Whether we like it or not, we have to. And we are, slowly. But that takes people to kind of push that boulder uphill. And it's somewhat of a thankless job, and it's a very difficult job, and it's a very painful job at times, but it's also incredibly rewarding, because when you do get to the top, and if you don't get kicked back or roll back, it's actually pretty amazing if you were able to take an organization that has zero incentive, in fact has all the incentive of not doing something, and you get them to do the thing that they needed to do, which ultimately then also hopefully translates into something good and of lasting value.
You have a particularly, if not unique, then certainly privileged perspective and position in being able to see the range of, let's just say, founder models that work. Talk to me about some of the sort of the trends that you're seeing and some of the kind of more proven approaches, particularly from a founder perspective, that you go, actually, you see it and you're like, this is what's working, this is what this guy needs to do.
I think the founders that are able to transcend building in the tech that they obviously have incredible domain knowledge in, but also are able to extrapolate that into, let's stick within the DeFi and TradFi space, right? Understand DeFi really well and understand what it can do, but also understand TradFi. And what I mean by understanding TradFi is that understand what the problems are. Most of them know what the problems are, but also understand why those problems are there. I said this earlier today, which is, there are reasons why these kind of opportunities or problems are there. It's not always because banks are stupid or we're too lazy to look at those. We know very well what the issues are. Some issues are just not worth solving because it's not commercially viable, and some of them we've tried, but either our infrastructure is very problematic, regulations make it very problematic, and so if you don't have that understanding, you come with this cool technology, and go like, oh look, I can just solve this 300-year-old problem easy by doing this. I mean, have a little bit of respect for the problem. understand it in detail, and then it's fine if you have something that can actually solve it, by all means. But I think where most of the builders where it doesn't go so well, what I've seen at least, is that they didn't really understood the problem they were solving. Sometimes they see a problem that we don't actually consider a problem. So if you push a solution to me for something that for us is not a problem, why would I listen?
What's a good example of that? So either not inventing, but defining a problem where most people wouldn't see one, or misdefining a problem.
I think there's a lot of things where you can make something better for customers, but the unit economics don't add up, right? That's number one. Or there's things like, I can increase whatever, X throughput by 20%. But 20% for us, the cost versus the outcome is just not worth it. Because for you, it's easy. It's 20% from zero because you already built a tech, right? And it's just plug and play. But for us, it's a whole, like 45 legacy systems, all kinds. When banks have to make a decision, especially when it comes to implementing new technology, right? It's not one decision. It's like 45 micro decisions by a bunch of senior people, each of which has every incentive to say no, right? And it's something that doesn't necessarily generate massive amount of new revenue or income in day one, let alone year one. It may over time, but we are focused on Q1 and Q2 and H1, right? And then your bonus as a banker is linked to fiscal year. And so you have all of these notions that make it far more prohibitive for a bank to be able to embrace these things, even if there's an actual, benefit that we could get out of it. But the way we assess the business case is fundamentally different.
I'm going to put a thought experiment in front of you. In the UK, I'm from the UK, and arguably the UK has a lot of fintech innovation, sort of traditional fintech, when it comes to how we do banking rails, payments, etc., etc. But the large legacy institutions, and I don't have to name any names, but they're sort of the largest banks that operate in the UK, are arguably still a bit clunky, have systems from the 1970s which have a huge amount of friction in them, etc. But still have millions and millions and millions of customers and are incredibly, liquid and sort of high growth. Is that because trust is really important? As a consumer, yes, I want things to be easy, but I also want to trust the solution in place. And if that's true, how does that impact on the evolution of more general Web3 projects, even within banks? Arguably, Web3 is a sort of a widely understood set of industries, lacks the same level of trust as some of these established institutions. So the question is, how important is trust? And is that really the sort of the currency of success almost for a lot of these projects?
Well, the answer to the first question is very, right? How important is trust? Very, very important, particularly when you deal with people's money.
Yeah.
Right? Or, I'd say money, medical side, like trust is incredibly important, and trust is earned over time. And I think that's really the bigger issue, is that, banks, for, better or worse, have had a significant amount of time to prove what they can and cannot do. It's trust, and I would argue say a little bit of comfort that people have. If you look at Revolut as an example, right? They were able to build that trust, and many like them, Nubank, many like them. So I think you can build that trust, but then also that takes time. And I think if you look at the fintech cycle, that's pretty old by now, right? It's been, 10, 15 years maybe? So it took time for them to get to this level. I think Web3 is still incredibly young. The second problem that Web3 has always had is that it just takes one hack.
Yeah.
Or, FTX that people still bring up, or Luna, or, Mt. Gox, whatever it may be. And a whole industry is tainted by that, which I don't necessarily think is fair, but I sort of understand it because you're completely new. People don't know you, and then they see these things, and that impacts trust. I think people trust banks, yes. I also think that's why banks will probably not go away. Their role might change, but I think in terms of as a trusted marketplace and intermediary for people, they'll always have a place. The second thing is this, that trust is also backed by regulators who are then representing the government. So that there is an oversight by the government. Now, whether you trust your government or not is a completely different conversation, but you're being held accountable as a bank. There are certain things we can't just increase our rates, right? If you have a dispute with me on a deposit or something, you can actually go to the central bank.
Yes.
Now, if you do that in Web3, you have nowhere to go.
Yes.
And so I think those are the kind of trust elements that people sometimes underestimate how important they are for the average consumer.
What I always tell people about my sector that I work in, for those who are unfamiliar, is, crypto Web3 is one of the few sort of sectors in the economy that are running towards regulation.
Yeah.
With good reason. What do you think is, if not missing, then could be better evolved from a regulatory perspective to help solidify and build that trust that's maybe missing at the moment?
I think we're getting there, to be honest. I don't necessarily think there's much more that can be done. If I look around the world right now, you have the Genius, you have Clarity coming out, Mica in Europe, UAE has probably gold medal in terms of how many different frameworks we have for different things. So I think the frameworks are getting there. And the other thing is, I think the regulators are getting up to speed. They now increasingly are hiring people that actually understand the technology, right? Because it's hard to regulate for something that you don't fundamentally understand at a technical architectural level. So I think that the regulators are doing everything they need to, and they're providing more clarity to companies. I think the natural next step will be, to your point, they're running towards it. It will start coming towards them, right? It will start coming towards them because there's a better understanding of what they're actually doing and what kind of regulations they would require to be compliant. Now, I also think there will be Web3 companies or protocols catering to the DeFi market, and they will always stay purely decentralized, utopian, Satoshi, and that's good because there's a market for that. But I genuinely believe that the majority of people, most people that have a normal bank account, don't really care about decentralized. They don't want to have self-custody. They don't want to have any of those things. So they just want to have slightly better banking.
Yes.
Right? And slightly better banking can be done by taking some of the better practices, the easier practices from Web3 and embedding them under the hood in the plumbing that makes the financial world tick.
I think that's a really astute point. Give us an example that you've seen, maybe two examples if you can, that enable the slightly better banking from a Web3 perspective.
The simplest thing is remittances. You can keep everything the same. You could literally keep it at a physical location where people go and give cash, and a physical location where people go and collect the cash. But like from A to B, you can run it over stablecoins, which a lot of people are doing, right? I think that's a very obvious use case where it's under the hood technology. And the argument I would typically make is this. If you ask people in any kind of conference room, how many of you can explain what IMAP is as a protocol, or TCP/IP, right, which kind of powers the internet? I don't think many people would.
Right.
Also, I don't think many people should.
Yeah.
You know that if you go to Google, you type something in, there's a website. Or you know that if I send an email to Paul, it will arrive in his mailbox. Stable coins and everything, tokenization, all of that stuff should disappear from the vocabulary and just becomes plumbing underneath that enables something. A to B. I don't think people really care about what you call it. I don't think people know how Swift works, as an example, right?
Yeah,
or even more complicated, how, when you make a credit card payment, who's involved in that chain, right? Beyond just MasterCard or Visa or wherever. And so I don't think people need to know that. So in my mind, a lot of these technologies will sort of disappear. And when we stop talking about them, that's when real adoption would have happened. And I think that they naturally slide in under the hood in terms of how we do banking or how we do payments or how we do any of these financial services. The hard part will be, I don't think you'll ever fully transform it because, to your point earlier, we're talking about mainframes from the 70s. I mean, people talk about crypto, like forget crypto, just basic automation, back office automation, not even AI, basic back office automation is incredibly difficult. Many people still do regulatory reporting through Excel, right? And so, yeah.
A silent revolution, it sounds like, is kind of what's necessary. I want to turn briefly to the concept of tokenization.
Okay.
And the first thing I'm going to ask you to do is an exercise I always do with my team when they're trying to explain something to me. I said, so look, imagine I'm a moderately intelligent 14-year-old. What is tokenization to that kid?
An overused, overhyped term that you really don't need to understand.
Fair enough.
because again, I'll give you my definition of it. But at the core of it, for me, the whole problem is that we have to explain what tokenization is, as opposed to what it actually does and why it's good for you. I think the simplest answer is that if you want to buy a thing, let's say you want to buy a Ferrari and you can't afford it. No, let's do it different. You want to buy a piece of art. Let's stick in that area, right? You want to buy a Van Gogh, which for many of us, including me, is far outside of our reach for now, inshallah, right? But let's say you wanted to own a piece of that for whatever reason. I can break that Van Gogh into multiple little pieces of ownership, each representing a share, no different from buying a share from, Amazon or Uber, which we talked about. And that's ultimately what tokenization is, with slightly better technology. And I can explain to you how it works on the blockchain. But again, I don't really think it matters to people. What does it do for you? It allows you to buy a piece of something where you can't afford the bigger piece, or where the bigger piece is far less liquid. And so now you have a smaller piece, and you argue you could sell that easier. The problem I have with a lot of the tokenization things is people solve for the technology and the coolness of I tokenize something. But then the question that I always ask is, okay, well, where's the liquidity?
Yeah.
Where's the secondary market?
Yeah.
Someone asked us as a bank, can we do micro mortgages for tokenized real estate, right? RWIs. Idea is pretty cool. Like if you were to be able to buy a tenth of an apartment, why would I not be able to give you like, you know, maybe a 20th of well, 50% of that is a mortgage. But then here's the first question that my chief credit officer is going to ask is, so what happens if you default and we're stuck with these tokens? How easy is it to sell them? Well,
yes,
not that easy, right? And so why would we do it? And so the problem I have with tokenization is don't take something that's illiquid and make it fractionally illiquid.
Yeah.
That is not a solution. Now, tokenizing private credit, treasuries, even deposits, I think there's use cases for a lot of these things. But I think this notion that there's a whole market of retail just waiting to have access to tokenized stuff, I'm not so convinced.
And retail property, to use your example, it is so widely talked about from a kind of tokenization perspective. Do you think it could ever work? Because there's real world utility, right? For, I don't know, recent graduates who are looking to get on the housing ladder, or people who are looking to sort of start a property investment business. People would like that to work. Do you think it could?
I don't know. There's a couple of things you need for that to work. I think right now the model that most people use is an SPV, right? Which is effectively, you're not tokenizing the actual underlying asset. You're creating a structure that you then tokenize. And I think in the UAE, they're fairly advanced, where you can tokenize the title deed, which I think is the great first step if you really wanted to do this. Yes, there's stuff you can do around, you could make it an Airbnb property where you can, you know, give yields to people based on the token, based on the rent. On the rentals, maybe people with tokens can actually use that apartment for a certain period of time. I just haven't really seen a lot of demand for that, honestly. You know what I'm more excited about from tokenization? There's someone who's building an index fund for collectibles. And so like, let's take an example of Pokemon cards, which can be incredibly expensive. And so I think that's great because it's a store of value that is fairly liquid anyway. And then you tokenize it and you give people access to smaller bits and pieces of it, easily tradable. It's, you know, the asset itself, I think has a, well, it's a collectible. So it has a collectability factor, which means there tends to be more on demand. And I think that's a really interesting use case. But I think real estate, beyond cool PR, I haven't really seen a great use case. Mind you, if someone solves the liquidity, maybe. I mean, would you? In the UK, for instance, you have these schemes, right, for buying an apartment together.
Yeah,
I think
we do.
So, do you think that tokenization would help?
No, it's the short answer. Yeah. The first problem is understandability and trust. And the second problem is I need 2-3 elements of tokens in order for it to work. I don't want to tokenize a property 100 or 1,000 times because why would I want to do that? Speaking of tokens, do you think it's fair? Do you think the following statement is fair? Most tokens aren't genuine or successful revenue models, but still so many tokens are issued. So the first part is, do you agree? The second part is, if you do agree, why are still so many tokens being issued?
I agree completely. Why? Because it's a very profitable model for founders and early VCs. I'm struggling to find a way to say this in a nicer way, but I think you're front loading the extraction, right?
Yeah.
Ultimately, it's like, why does anyone ever do anything, including banks, right? It's because there's incentives and there's trade-offs. And if we are incentivized to do something and we're allowed to do that, right? Why would you not do it? I think a lot of founders look at it and go like, well, I can issue a token. Now think about it differently. When Amazon or Uber was kind of, you know, subsidizing user acquisition, they did that with dollars, physical dollars. So the cost is measurable. But when you print your own money, it's really, the cost becomes very blurry, right? So I have no idea. You can literally print it as you see fit. The incentive now is you issue the token, you take a lot of money out of it, and then you have what? You have no more incentive to keep building. On the VC side, in the traditional business, you still have that because now you need to get to a certain point where you have an exit event, right? A liquidity event, whether it's a big Series A or a Series B or whatever. But from a token perspective, once you've done, the first TGE and it's unlocked, it's gone. There's a reason I sit on the board of an AI startup. There's a reason why we vest, equity. Because you want to align the incentives of the building team with the market or with the investors. I think when you look at these token models, you do the opposite.
So tokenization or kind of the token models need to move from at one extreme kind of pump and dump to a much more kind of mature, incentivized, vested model if they're going to work in the kind of sort of real world, particularly with raises and business models.
Yeah, I read a stat the other day that said that almost 90% of all tokens are underwater compared to TGE. Right, and it's not completely surprising. The founders that I talked to, the ones that were meant to do a big TGE like this year, they're all rethinking the model and they're trying to figure out, wait, how do you do this in a more sustainable way? Because I don't necessarily think that all founders will just want to extract. I think most of them actually don't. It's just that they follow the playbook where you get to this point, you do the TGE and then you realize like, oh, right, like now what? And now, not only that, now you're enslaved to kind of keeping that token price at a certain level because the perceived success of your company is now linked to that token. Even though you really have no means of, no sustainable means to kind of push that up because you haven't really worked on the business that's underneath that token. So I'm kind of hoping that someone cracks it one of these days. And there's someone, I'm not going to shout them out because they shouldn't, but there's a couple of protocols that I know are having some really interesting thoughts about how can you fix this.
Sure.
So let's see.
We've talked quite a lot skeptically, and I think that's a really healthy thing to do, particularly in our sector. You kind of need to see what's real from the mist. Turning sort of almost to the other end of that spectrum, give me a few examples of the Web3 business models that you think, oh my God, it is just going to work. Like I see the use case so clearly, and this is how it's going to work.
Stablecoins as under the hood technology, obvious. I know, like I said, for me, we can stop talking about it. The suits have arrived. They all agree. I was at Proof of Talk yesterday. So many suits. Everyone understands that this is the new plumbing of the financial markets, right? So stablecoins, 100%. Tokenization applied the right way, 100%. Many, many use cases, makes total sense. I think identity management, very, very interesting. I haven't seen the kind of applications yet that I think will really shake things up, but it's coming, and I think that's going to be a massive driver going forward. I'm very bullish on privacy. So anyone who does kind of like native privacy, because especially if you look at Web3, it's nice that everything is a public ledger, and it kind of it creates certain benefits, but it also creates the problem that if everything is public and everything is immutable, I don't necessarily think that either institutions or retail consumers want their entire financial history and transaction history to be publicly available for everyone. So I think privacy, and particularly on the ZK side, meaning regulatory compliant privacy for the kind of average person, but at the same time, the government or whoever else, the regulators should be able to validate who this person is. And so I think those are some of the bigger things that I think are really interesting. I'm trying to think of this. Anything else from a Web3 perspective?
I think there's some really interesting examples there. And the two you mentioned, privacy and sort of identity management. A founder from one of those sectors or with one of those kind of models comes to you and says, you know what, I really want to make this a success. How can I do this? How can I make this a success? What's the first question you ask them back to kind of cut through the hype?
I mean, the first question genuinely for anything is like, what's the problem you're solving and why? Right? And it will tell me whether or not you actually understand that problem, because you could answer it in the right way, but if I ask you the why, it may tell me that, well, you have the right problem, you don't actually understand that problem well enough to be able to solve it. And then the other thing I ask them, especially if it's, most will either be B2B or B2C or B2G maybe, who's going to pay you for this and why? Because if you don't know the answer to those two questions, then you might have a great solution, but if you can't monetize it, we're going to get stuck where we were with the token, right? There is no underlying fundamentals. And so just having technology that solves a problem is great, but that's one part of the problem. The second thing is, who's going to pay you? how much would they be willing to pay you, and why would they be willing to pay you? And the why part is also around, why you, why not someone else, and why would they stay with you?
You've gone into a traditional sector, let's say, or rather a kind of legacy sector, and not only are you sort of bringing them into the kind of Web3 future, you're successfully getting them to put, money, reputation, risk on the line, so to speak, for that. How did you educate and bring some of those people along that journey with you?
That's a tough one. One thing that doesn't really work is just talking about stuff like this.
Yeah.
It's too conceptual, and if you've never experienced it, my advice to most bankers is always this, right? Get a wallet, ideally self-custody one, but if you want to go for one of the big exchanges and get one of their wallets, fine. Get a wallet, buy a token, right? Buy USDC, right? Don't buy a meme coin, buy USDC or Ethereum or Solana or ideally Bitcoin. Hold it for a little bit and see how that feels. Buy an NFT or anything else, just because then you understand how a transaction works, right? How ownership works. You also understand why some of these things have a lot of friction and are far removed, in my opinion. I always go on, but I sometimes ask builders, like, why? Do you hate users? Like, why do you build such poor UX? Because the standard that fintechs have set is a very high bar, I think, in terms of what UX should look like. Yeah. Or forget fintechs, the Ubers and the Amazons of the world. And a lot of Web3 interfaces are still very, you use the word clunky, I think, right? They're still very clunky. And that's, if you want to appeal to people that already don't really understand the technology and have every incentive not want to try something else, you better have really great UX from an onboarding perspective. But anyway, that park that aside, it's a tough question, actually.
It's to experience it and use it with real world utility. And I think one of the examples that you gave earlier on with remittances is the realest and simplest world utility for a lot of these kind of like tokens, protocols, or coins.
It is, but I was thinking about how do you convince, let's say, C-level individuals, right? The most successful, God, I shouldn't say, the most successful strategy has been getting people to buy meme coins.
Yeah, interesting.
Simply because meme coins at some point took over the kind of zeitgeist, right? And in particularly when a particular president from a very big nation launched his own meme coin. But it was actually a great moment because he did that and he allowed people to buy from his website with credit cards.
Yeah.
So in a way, he removed all the friction.
Yeah.
It was actually super easy. There was a massive, I would say, FOMO happening. Like people really wanted to, buy that. And I think it was a great lesson for people on how Web3 works, because a lot of people did that. Then they have to understand, so what are you really doing? You're using a credit card to on-ramp and you buy crypto that is now going into a wallet that was not completely, depending on how you did it, either self-custody or you used the custodial wallet that they provided. And then you see the token go up and down and up and down. And actually, I think later that night it crashed when he launched his wife's token. So I'm like, you went through a full crypto cycle in 24 hours.
Yeah.
The interesting thing with that is when people realized how much money was made, right, by that token, that specific token that shall not be named, people understand, well, wait a minute.
Yeah.
So you can basically, if you put this as a banker perspective, I'm like a central bank who can print their own currency, issue that, influence the price, and then extract all the value out of it, and there's no supervision whatsoever.
Fascinating.
Tell me more.
Fascinating. Final thought on a slightly different subject. You talked a lot about NFTs. A few years back, we saw...
I'm probably the only person who still talks about NFTs.
Well, this is the question. A few years back, we saw an explosion, a lot of excitement.
Yeah.
Genuinely, I wouldn't even call it hype. Like there was excitement in terms of the sort of protocols, technology, etc., and possibly a constriction since then. Is this the kind of natural state? Are we sort of talking about a phenomenon, a technology which actually is sort of quite niche, and that's fine, and it's going to stay there? Or do you think we're going to see another expansion?
I think it's a technology that was early. And I think like most technologies that are early, there's a maturity curve. I think it went overhyped too quick. It became too easy of a means for extraction, which kind of attracted a lot of the wrong behaviors. But I think as a core technology, it will have its day. I believe that. Specifically in the NFT, the art side, I still think that, on-chain, immutable art makes sense. I still think that provenance makes sense in terms of when did you inscribe it. And that's from a collectible perspective. All of these things actually add a lot of value. It makes a lot of sense. And I genuinely also believe that in the case of physical art, tokenizing actually has a place. So my sense is it will come back, but nowhere near as hyped as it used to be before. Probably a little bit more niche. And if you look at the NFT as collections, there's probably a few blue chips that will survive. And
Final question.
Yeah.
What traditional piece of art would you most want a token of?
What traditional piece of art? Ooh, I'm going to say something bad first. Definitely not the Mona Lisa. Don't ask me why. Ooh, that's a tricky question. I would probably, let me reframe it. If you were to say what kind of piece of physical art would you most like to own, it's going to be the same answer. Because right now I can't own it.
Sure.
So maybe the token will work. It would be a Basquiat.
Wow, of course.
Yes.
Very cool choice.
Yeah.
Very cool choice. Gio, thank you very much.
Thank you for having me. Thank me for coming here.
Yeah, thank everyone.